Let's not fight about it. Let's talk about it. The buy term invests the different strategy versus getting a universal life or the insured retirement strategy. Let's compare and contrast based on facts and figures and not based on preferences and sentiments. Shall into the details, I need you to understand something. All financial products are good, but not all financial products are good for you. Determining the best financial product for you is dependent on your own unique financial needs and goals, and not the preference of your advisor. And that's why it irks me when I see certain advisors or influencers like Dave Ramsey label certain products as scam based on their own lack of understanding of it, and then promote some other products to everyone based on their own preference of it. Financial products are not shelf products, so it's always different strokes for different folks. Getting a financial plan is actually dependent on that individual's financial needs and goals. I mean, the insurance industry is highly regulated, so why would the regulators allow insurance companies to create bad products and sell it to the people? It doesn't make sense, right? So there is no bad product. Every financial product is good and has its own uniqueness and its own benefits. So let's have that at the back of our mind. Now let's do a little bit of brief history of how life insurance came about and how we got to where we are currently. The first ever type of life insurance is a term insurance. Is the first and the most basic type of life insurance coverage, and it basically provides coverage in case a person dies within a particular period. It pays out a lump sum to the person's beneficiary, and so those ones can continue to live their life as if the person was still with them. However, a lot of people did get term insurance policies, but they outlived the policy because the policy only pays out if death happens within a term. And people started complaining about giving life insurance companies money for so many years and then nothing comes out of it because they have refused to die. So based on the limitations of the term insurance, of course, the insurance company came up with the whole life insurance product. And as the name implies, it provides protection for the whole lifetime of the insured. However, it came with its own limitation in that whole life insurance is quite pricey, it's quite expensive, and it's also very rigid. You can't make so many changes in the lifetime of the contract. And based on those limitations, people had issues with it. And so, yes, the insurance companies came up again, and about 4 decades ago, they came up with a universal life insurance. It also provides coverage for the entire lifetime of the insured, just like the whole life. However, it kind of fixed some of the issues that the whole life had. It's less pricey than the whole life insurance, and it's a lot more flexible, a lot more transparent than the whole life insurance. And that's the universal life insurance that we have today. I hope that little history kind of gives us an understanding of how we came about the term, the whole life, and the universal life insurance. So we're just going to switch to the screen now and take a look at the numbers. Like, okay, if I am a 30-year-old female and I had $250 to invest on a monthly basis, and my goals were to actually have a life insurance coverage and also save and invest something for my retirement. What does it look like if I adopted the buy term, invest a different strategy? And what does it look like if I adopted the universal life insurance or the insured retirement strategy? So that's what we're going to be looking at. And I hope that by the end, we'll be able to determine which one works best for us.
Now we're going to crunch the numbers based on actual facts and figures. Buy term invest difference versus universal life insurance. So let's take a look at our case study. Our case study is Jane Doe. She's a 30-year-old female, non-smoker. Our goal is to get life insurance protection now and also have a long-term investment. Our budget is $250 monthly for a period of 30 years. She's hoping to get up to $750,000 of life insurance coverage, and she's wondering if she should buy term, invest the difference, or she should get a universal life policy. So let's help her out. So now we're comparing both strategies. The first one, if she were to buy a 750K coverage, term 30, our monthly premium would be $57.15 monthly, right? Now, if she subtracts this from a budget of $250, the difference would be about $193 approximately. And then if she decided to invest this difference at 6%, this is what the figures would look like. Right. If life is short and unfortunately Jane passes away in year 5, of course, year 5 is still within the 30 years term, so the life insurance company would pay out $750,000 tax-free to Jane's beneficiary. And the difference that she's putting away at 6% will now be worth about $13,532 at this point in time, right? So total is like $763.532. Right. But what if life is long? What happens to Jane at age 61? Well, because her term is for 30 years, it expires at age 60 since she started at age 30. Right. And so by age 61, Jane would no longer have any coverage because her term would have expired. So life insurance coverage is at zero at this point. Right. And what that basically means is that the total of about $20,000 that she had contributed in the past 30 years, the insurance company gets to keep it. And that's fair because they actually provided her the coverage. During those years, it is she who refused to die. If she had passed away, they would have actually paid a whooping sum of $750,000, which is way higher than a total contribution of $20,000. That's why I love insurance. For small contributions, you can lock in huge amount of money. Right. Now, if Jane feels like she's too young not to be without coverage, and she wanted to renew a term 30 at age 61, her renewal premium jumps up to $1,380 monthly, and that's insane actually. But yeah, that it is what it is. Her premium jumps up from $57 monthly to a whooping $1,380 monthly if she wanted to renew a term for another 30 years. And her investment balance at age 60 that she had been investing, this $193, will now be worth around $194,000, 840. So that's what it looks like on the buy term invest a different side of things. Now let's switch to the UL side of things. If she decided to get a $750,000 universal life insurance coverage, which is basically permanent, and she's contributing $250, and we're going to assume that investment portion did 6% per year since we're comparing apples to apples. Now, if life is short and Jane unfortunately passes away in year 5, how much is the payout? Actually, it depends, and that's one of the major features of the universal life insurance policy. It is very flexible. The death benefit option are actually of two types. If she opted for the level death benefit option, the life insurance company pays out a total of $750,000 to her beneficiaries if she passed away in year 5. However, if she opted for the increasing death benefit option, the life insurance company pays a total of $764,000, 750 to our beneficiaries, and this is essentially a life insurance coverage plus all the cash value that has been accrued in the policy up until this point. Well, but from my experience, I know that the cost of insurance on the level death benefit option it's cheaper than the increasing death benefit option. But based on whatever you prefer, you have options. Let's look at what if life is long. At age 61, a life insurance coverage, if she opted for the level death benefit option, will still remain at $750,000, even though she has stopped contributing because her plan is permanent, remember? So she still has a life insurance coverage intact. If she chose the increasing death benefit option at age 61, she would now have a total life insurance coverage of $975,000, 354. Right, so contribution stops, but our coverage remains for life, and our cash value will continue to compound and grow. Now, a cash value at age 60 under the level death benefit option would be about $232,000, 974. And under the increasing death benefit option is slightly lower. A cash value at age 60, based on the market performing at 6% per annum, would be $225, 354. One can actually access these cash values that has been accumulated in one's lifetime and without having to pay taxes if one used the collateral loan strategy. And that's like a different topic for another day. Let me know in the comment section if you want me to break down how collateral loan works for permanent life insurance. So in case you're wondering where my source is from, right here you would see my for the investor difference portion of things, I used an online calculator, 6% interest rate, and you would see right there at the end of year 5 our balance was 13,005, and by the end of year 30 our balance was $194,000. So I just used an online compound interest calculator. And as for the universal life insurance, I actually got my illustrations from a reputable life insurance company in Canada, and so they're real figures. Like I said, they're not made up numbers. And under the level death benefit option, you see the death benefit is level, it's the same, and you would see right here that the cash value at age 60 at the end of the 30th year is at $232,000. And even though our contributions are stopped at this point in time, you will notice that our cash value continues to compound and grow, and our life insurance coverage is still intact. Under the increasing death benefit option, you would see right here from the beginning that the death benefit increases every single year from the initial $750,000. And then you would see also right here that our cash value at age 60 is at $225, and it continues to compound and grow even though our contributions are stopped, and our death benefit also continues to grow as well.
So, I leave you to be the judge to determine which of those strategies work best for you. Whichever one you decide, whether it's the buy time and invest the difference or the universal life insurance, be rest assured that I can help you set them up. That being said, in order for us to be able to make a more informed decision, I would like to talk about the pros and the cons of both policies. For the term insurance, talking about the pro, number one is simplicity. It's absolutely easy to understand because it only provides coverage for the risk of death. A person gets this coverage for a period of time. You die within the term, the insurance company pays. You refuse to die, nothing is payable. Simple, right? Number two pro is affordability. The term insurance is actually very cheap. So no one has an excuse not to have life insurance in place because one could actually go term and you can get policies as little as $25 per month. That's less than the amount you spend buying coffee on a monthly basis, just to be able to take care of your family, protect their future, and to make sure that they're not left stranded. Term insurance is absolutely affordable. And then number three is convertibility. Like one can actually convert term to a more permanent option. When your financial needs and your goals changes, you can easily convert the term into a permanent option, and of course when it expires as well, you can renew it for another couple of years. So those are the main pro of the term insurance coverage. It is simple and easy to understand, it is affordable, and it is convertible. You can change it, you can change its form as your financial needs and goals changes over time. Now let's switch over to the cons. Number one con is that it provides limited coverage. One has to pass away within the term before the benefit is paid out to one's loved ones. A tragedy has to happen to trigger a claim under a term insurance policy. And not only does a tragedy have to happen, but it has to happen within the term while the policy is still valid, active, and in force. Two, it has no cash value component. You can't use the term life insurance policy to grow any kind of investment. It absolutely has no cash value. It also has no living benefits component. It's just strictly term, covers strictly the risk of death. Nothing more, nothing less. Another major con of the term insurance is that the price jumps up at renewal. So if you were a 30-year-old and you got a 20-year term and it expires at age 50 and God has been gracious to you and you're still alive and kicking and you feel like, oh, I still have many more years ahead, I need to get more coverage, and you decide to convert your term to renew your term for another 20 years or so, the price could be as huge as times 4, times 5 of what you're currently paying. And many people find that quite weird, and they just basically drop their policy. Let's check out the pros of the universal life insurance. Number one is it provides coverage for the entire lifetime of the insured. So once the policy is set up, one actually has it up until they die, whenever death happens. Number two is it allows us to grow cash value, right? So there is always an investment component, right? The universal life insurance is essentially a hybrid of life insurance and investment. So life insurance takes care of the risk of death, but then there's the investment component that allows you to accumulate cash value that you can access in your lifetime. Also, there's huge potential for investment growth because the investment component of the plan rests on the financial market and has the potential to actually yield a lot and compound over time. Of course, the market fluctuates and goes up and down, so it could also go sideways. We talk about that when we're talking about the cons, but there is the potential for huge investment growth over time. Also, the universal life insurance has a lot of tax advantages, as the money that you grow in the investment component is growing tax sheltered. So you don't have to pay taxes on your gains as long as the money remains within the policy, right? So that's tax-free wealth accumulation. And also, you can actually access the money from your universal life policy tax-free if you decide to take it out using the collateral loan strategy. And that's a topic for another day. But yes, you can grow your money tax-free within the universal life policy or tax deferred. And then when you want to access the money, you can also take it out tax-free using the collateral loan strategy. And then, of course, eventually when you pass away, you get to pass down generational wealth to your beneficiaries, also tax-free, because death benefit is not taxed in Canada. Another pro of the universal life policy is its flexibility. The policy is so flexible that you can increase your premiums, you can reduce it. If you run into a financial problem, you can take a break without losing your coverage. Our term insurance policy does not give us that luxury. It only gives us 30 days of grace. If you're not able to pay up, then our policy stands the risk of lapse. But people could actually take a break from their universal life policy for several months without necessarily losing their coverage, as long as they have enough cash value within that policy to keep it going. Right. And also there are bonuses and perks by different product providers that basically just adds more value to the plan other than the investment returns that the plan is getting from the market. These bonuses goes a long way in helping the plan to grow and thrive in the later years when you have actually stopped contributing into it. So now let's take a look at the cons of the universal life insurance. One would be like it is more pricey when compared to the term, and that's understandable. It brings more value and it also provides coverage for the entire lifetime. So one would actually have to pay more to actually keep a universal life policy in force. Two is the market risk. Of course, when it comes to the market risk, the investment component of the universal life insurance policy rests on the financial market. And the normal behavior of the market is that it would fluctuate from time to time. So whenever the market goes down, it also reflects in the investment account, and whenever it goes up, it reflects. However, I personally don't care too much about that because it's a long-term coverage. But anyways, we're going to have the policy for one's entire lifetime, and in the long run, as far as the market is concerned, there is always growth. So since it's long-term, the market risk may not necessarily be a huge issue, but it's worth mentioning that the investment component actually rests on the financial market. Another con of the universal life policy would be that there are penalties for early cancellations. Yes, it is meant to be a long-term plan. Unlike term, whenever you cancel it, you cancel it. There are no penalties because you're not accumulating any cash value. It's just the cost of insurance that you're putting in. But with the universal life insurance, if you were to cancel, for some companies within the first 10 years in the policy, it would attract some penalties for early cancellation. And of course, we can't blame them for doing that. It's a long-term contract. Some people should be disciplined enough to stick to their plans. But that's also a con because you can just turn around and say you're no longer interested and you take all your money. However, if you've had your policy for more than 10 years, you can as well cash out all your cash value, take out all your money, and then walk away without having to deal with any penalties. So I hope we have actually been able to gain more understanding on how the term insurance works, how the universal life works, and of course we'll be able to make more informed decisions about the best coverage for yourself and for your family going forward. Alright guys, that's it for today. Share your thoughts, share your comments, your contradictions, your beliefs on the vitamin invest the difference strategy or the universal life insurance strategy. I love reading from you. I love hearing from you. Share it with me in the comment section. And of course, don't forget to share this video with your loved ones so that they can be more informed and more educated when it comes to setting up financial plans for themselves and for their families. Thank you once again for dropping by my channel. I'll see you in the next video. Bye.